Hello, and thank you for joining in this week's market update.
Latest news.
As the conflict in the Middle East goes on, reports of attacks not only on American military assets, but also across the region have seen more escalation and more tensions within the area. The conflict, which is now physically spread to across the Gulf, saw an attack on critical Fujairah oil port and forced not only Dubai's international airport to temporarily suspend flights, but also prompted the port to suspend oil loading operations. This has removed a vital bypass route for the UAE crude exports, and the attack also removes a key alternative through the Strait of Hormuz, which continues to be de facto closed. In this sense, we've seen Trump now demanding allies such as NATO, Japan, and China to send their own naval vessels to help the US secure the passage through the Strait of Hormuz. He's applying significant pressure, warning of a very bad future if NATO members fail to assist Washington in these efforts. Some countries have openly outspoken against the possibility of them sending warships to the region. However, some, like for example the UK, is reportedly drawing up plans to contribute in minesweeping efforts rather than sending escort ships. This has highlighted the reluctance for direct military engagement for other key members of the American alliance, and also, of course, uncertainty over the timeline and feasibility of reopening the strait in the near future. On their part, the EU is considering emergency measures amid the energy price shock, especially in the short term. As we know, this has prompted sharp political reactions in Europe, and one of the more outspoken governments has been the Italian Prime Minister Meloni, calling on EU to suspend emission trading system for fossil fuel power generations to lower costs. The EU ministers are set to meet on March 19 and will debate if these measures make sense or not. This has, of course, dropped significantly prices for EUAs, as we're going to see in a few slides.
Weather.
Silver lining to all of this, demand in Europe has remained subdued, largely due to what you can see on screen, with higher temperatures than usual across the entire European region. Maybe more on the power side, but we've also seen a pickup in wind generation, which is expected to continue up until the 4 to 6 day forecast, whereas precipitation is largely set to be relatively contained and mostly seen in Central Europe in the 7 to 10 day forecast, as well as Northern Europe and the UK in that same date range.
Crude oil and LPG.
Not surprisingly, crude oil prices have still going on upward momentum, as we've seen the May 26 contract for WTI jumping more than 10% week on week, whereas the Brent did even more so, jumping more than 11% for this past week. Overall, looking at the 3-month change, we're seeing May 26 future contracts trading at over 72% from where they were only a few weeks back. Several agencies, such as the EIA, have updated their forecast considering what is happening in the supply side of things, as is clearly seen here, where the supply forecast has dramatically lowered and has changed now the balance, the forecasted balance in coming quarters. However, it is very important to note that despite these big drops in expected supply, the agency is still expecting an oversupplied market, not only for the last few months of the year, but also even from Q1 and Q2 more specifically. Going a bit deeper, looking at the details, it's seen that the report is expecting everything to come back to normal around September of this year, all things considered.
Natural gas.
Gas prices seem to have stabilized at these high levels. Quarterly products retraced by just a hair this past week, whereas the long end of the curve, Cal 27 and 28, are starting to catch up with the bullishness seen in the front end of the curve. For example, Cal 27 has risen around 40% over this past month, where most of the bullishness was of course seen over the last 2 weeks. Also important to note that the summer-winter spread, which typically is the economic incentive to inject during summer and withdraw during winter, is now clearly distorted. It would be typical to see summer prices, namely Q2 and Q3, lower than those of winter, so that this economic incentive makes sense for suppliers. In this sense, we are seeing that the Centaurus situation is not as critical as before, mainly due to favorable weather. Inventory versus 2025 levels has now improved and is currently around 6% of a deficit year on year. As we go now into winter months, it will be normal for this time of year to see net injections, which is also almost the case now. But as we saw before, the economic incentive is not there. So in coming weeks, this will become critical as we move into the summer weather, but of course with less demand. EU gas supply remains largely dependent on Norway in pipeline and also American LNG. But as the situation develops and the supply crunch is being felt more in the short term, there are more and more people calling for ease of sanctions on Russian imports, which could see this picture change in coming quarters. However, most of the LNG is clearly coming out of the US. But of course, if this continues, then Russian dependence might come with the political cost that this entails. Asian markets are a lot more sensitive to the Strait of Hormuz closure, as we can see on screen, where JKM prices are far above from what we see in European markets. Also important to note that Henry Hub, which is the benchmark for American gas markets, is trading as nothing has happened and is clearly a lot more stable than other parts of the world. We're also seeing the increase in net long positions by the investment funds, which are trying to capitalize on this bullishness caused by the supply crunch and are now set to increase positions by the second week in a row.
Coal.
After a couple of bullish weeks, coal is also maintaining the momentum, and more stable prices are seen throughout AP2 and AP4 markets. This past week, price also consolidated, but bullishness has been relatively strong, where we see above 20% increases in both AP2 and AP4 markets.
EU and UK emission allowances.
As gas prices continue to be high, we might expect coal production to increase, which could affect emission allowances both in the European and the UK markets. However, for now, these remain contained, and the possibility of further relaxation of the rules in both markets have seen prices drop substantially over these past 12 weeks, as you can see on screen. EUA prices have dropped around 20%, whereas UK prices have almost doubled that bearishness over these past few weeks. The investment funds position is a clear vision of that, where net longs are decreasing week on week in EUA markets, while the UK continues to be sustained by the possibility of linkage between both European and the UK trading systems.
Electricity.
Following suit with other fuels, electricity prices have also declined slightly over this past week, where Cal 27 has now risen around 18% from where we were only a couple or few weeks back. Also important to note that quarterly products are 30% up during the month, but have seen less pressure, especially due to lower carbon and milder weather. Depending on the country and the supply mix, these moves are seen to be more dramatic. However, countries like France and Spain, with sustained renewable and nuclear generation respectively, have been a lot more contained. Important to note that Nordic prices have also experienced some bullishness, mainly due to the fact that the hydrological balance is still tight in almost every country here. Total grid demand has been lower, again, mainly on favorable weather, while residual load has kept on the lower side of the range, mainly on very satisfactory nuclear generation, but also we've seen a pickup in renewables, especially in wind generation, after an event with where we saw wind output drop by quite substantially, and also solar is starting to pick up. On the other hand, fossil generation has kept quiet so far, and with increased prices, this could change in coming weeks. Zooming in renewable generation, wind is set to pick up, and as we saw in the weather forecast, it will continue to rise over the following days, where solar generation is now being helped by more summer days or summer weather as we go out of winter. Important to note that coal generation, even though that it's continued to be relatively muted, we could see a shift in this if gas markets continue to rise. Finally, looking at guarantees of origin, following suit with other markets, this past week has been one of consolidating after quite a bullish run, especially in 2026 technologies. This was largely driven by compliance buying, but also, as said, the persistent Nordic hydro deficits that we're seeing.
That covers this market presentation. Thank you for joining.